Imagine a guy. He just walked out of the dealership with a brand new SUV, the keys jingling in his pocket. That smug little half-smile of a man who thinks he just outsmarted the entire American banking system. He's 67 years old. He worked 43 years for the school district. He paid off his mortgage in 2019. He hasn't carried a credit card balance since the Reagan administration. And he just refused with great pride the dealership's offer of 7% financing on a $50,000 vehicle. He wrote a check. He pulled $50,000 out of his traditional IRA, the same IRA he's been feeding for 30 years like a faithful old dog, and he handed it to a finance manager named Brad, who is wearing a polyester tie and a smile that should be illegal in 12 states. He drove off the lot, convinced he just saved himself $9,400 in interest. He didn't save a dime. He just walked into the most elegantly designed financial trap that the United States Treasury has ever constructed for the American retiree. And the worst part, the part that should make every single one of you absolutely furious, is that he won't even know it happened until October of 2027, when a thin envelope from the Social Security Administration lands in his mailbox and informs him that his Medicare premiums have just tripled. Welcome back. I'm the retirement insurgent, and today we are pulling back the curtain on what might be the single most expensive mistake a financially responsible retiree can make in 2026. The cash at the dealership trap, the pride tax, the stealth confiscation that the IRS, the Centers for Medicare and Medicaid Services, and your local Toyota dealer have all silently agreed to share between them like vultures over a corpse. If you have ever said the words, "I'll never have a car payment again," sit down and pour yourself something strong, because I am about to walk you through the exact mathematical mechanism by which the United States government converts your debt-free pride into a 30% confiscation rate on every dollar you withdraw. Let me tell you the story of the Clark County crime scene. Picture a couple, Hal and Diane. Hal is 68, a retired electrical foreman from a utility company in Clark County, Nevada. Diane is 66, a former hospital administrator. Combined Social Security, $48,000 a year. Pension from Hal's union, $22,000. Required minimum distributions from a traditional IRA he rolled over, about $30,000. Dividend income from a brokerage account, $20,000. They're sitting at $120,000 of income before they so much as sneeze. Their 2014 Buick has finally given up. The transmission is making noises like an espresso machine choking on a wrench. They go to the dealership, negotiate a $50,000 SUV down to $48,500, and feel competent. Then Brad slides over the financing offer, 7.2% for 60 months. Hal looks at Brad like Brad just suggested they raise goats in the living room. "I don't do car payments, son. I'll write you a check." He calls Fidelity, requests a $50,000 distribution. Because they withhold 10% for federal taxes by default, he actually has to request $55,555 to net the $50,000 he needs. 3 business days later, he walks back to the dealership. He writes the check. Brad shakes his hand. Hal drives home thinking he's a financial samurai who slayed the bank. Hal just lit $31,000 on fire, and the smoke hasn't reached his nose yet. This is not official financial advice. It is a survival guide for a rigged tax code designed by people who do not have your interests at heart. Consult a fiduciary CPA who doesn't sell annuities on the side. But don't tell me the IRS, in its vast and twinkling benevolence, is looking out for the retired electrical foreman in Clark County. They're not. They wrote the rules. And the rules are the crime scene. Here is where the trap begins, the debt-free myth. An entire generation came of age in the 70s and 80s when interest rates were brutal. Mortgages at 14%, credit cards at 22%, auto loans at 12, 15, 17%. They learned correctly that debt was the enemy. They paid down mortgages, cut up credit cards, sat in church on Sundays feeling righteous about being debt-free. That gospel was correct in 1982. It is only partially correct in 2026, because it never got updated for the most important development of the 21st century, the migration of middle-class American wealth into tax-deferred retirement accounts. Here is the part they hide. 40 years ago, when your grandfather paid cash for his Buick, every dollar he handed the dealer was post-tax. The transaction had zero tax consequence. He could have written a check for $100,000 and the IRS wouldn't have batted an eyelash, because he'd already paid his pound of flesh when he earned those dollars at the factory in 1971. In 2026, the situation is the exact inverse. The bulk of American middle-class retirement wealth, your IRA, your 401k, your 403b, your TSP, your SEP, sits in tax-deferred accounts. Every dollar in that account has never been taxed. The deal you made at 42 when you were contributing to that 401k was simple. You don't pay taxes now, you pay taxes later. And later is now. Later is when you write that check at the dealership. When Hal pulls $50,000 from his traditional IRA, that money is not his the way a checking account is his. It's a partnership distribution. And the silent partner, the one with the badges and the guns and the Internal Revenue Code, is sitting there with his hand out. Every dollar lands on his tax return as ordinary income. Not capital gains. Not qualified dividends. Ordinary income. Same category as wages, same as a paycheck. This foundational misunderstanding costs retirees $30,000 every time they save themselves from a car payment. They are not paying cash. They are converting tax-deferred income into ordinary income at the worst possible velocity, in a single calendar year, on a transaction that did not require it. Let me show you the math. The 2026 federal brackets for a married couple filing jointly. 10% up to $24,800, 12% up to $100,800, 22% up to $214,800, 24% up to $410,000, then 32, 35, 37. Hal and Diane's gross income before the withdrawal, $120,000. Their total deductions in 2026, standard deduction, additional over 65 deduction, and the new senior bonus deduction from the One Big Beautiful Bill, come to roughly $47,500. Taxable income before the withdrawal, around $72,500. They're comfortably in the 12% bracket with $28,000 of headroom before hitting 22%. Effective federal rate around 8%. They feel like the system is finally being a little fair to them. Now Hal pulls $50,000. Watch carefully. The first $28,000 is still inside the 12% bracket. Costs $3,360 in federal tax. The next $22,000 jumps into the 22% bracket. Costs $4,840. Federal income tax on the withdrawal alone, $8,200. Then bracket creep on their other income adds another $1,000 in indirect tax leakage. Then the senior bonus deduction phases out as Magi rises. They lose roughly $6,000 of deduction, taxed back at 12 to 22%, costing another $1,000 to $1,500. Nevada has no state tax, so they're lucky. California would add another 9.3% on top. All in federal cost of the withdrawal, between $9,700 and $10,500 on a $50,000 distribution. An effective federal rate of about 20% on the lump sum. Hal thought he was avoiding a 7% loan. He thought he was saving $9,400 in interest over 5 years. He didn't save anything. He paid roughly the same amount to the federal government in one shot, instead of paying it over 5 years to a bank that would have happily refinanced him in 18 months when rates dropped. This should make you furious. But we are not done. Not even close. Because everything I just described is the visible tax. The shrapnel. The wound you can see. The real damage is the wound you can't see yet. The wound that won't bleed until 2028. That wound has a name. Her name is IRMAA. And IRMAA does not forgive. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a federal surcharge on Medicare Part B and Part D premiums, and it is the most quietly vicious tax in the entire federal code. Most retirees on Medicare pay the standard Part B premium, around $265 per month per person in 2026, plus a Part D drug premium averaging $40 to $60. Standard, predictable, budgetable. What most retirees don't know is that those premiums are means tested. If your magi exceeds certain thresholds, you get hit with a surcharge. Tiered by income, assessed 2 years after the income year. That 2-year look-back is the key. In 2026, you pull money. In 2028, the bill arrives. The 2026 IRMAA tiers for married filing jointly, based on 2024 magi. Tier 0, magi under $212,000, no surcharge. Tier 1, $212,000 to $266,000. Part B surcharge of $74 a month per person. Part D surcharge of $13.70. Tier 2, $266,000 to $334,000. Part B surcharge of $185 a month per person. Tier 3, $334,000 to $400,000. Part B surcharge of $295.90 per person. Tier 4, $400,000 to $750,000. Part B surcharge of $469 per person. Each tier hits both spouses. IRMAA is per Medicare beneficiary, not per couple. Back to Hal and Diane. Their 2026 magi with the $50,000 lump sum is $170,000. Still Tier 0. No IRMAA in 2028. They got lucky on the IRMAA front, even though they got crushed on the income tax front. But change the example. Take Bob and Linda, retired teachers from Cuyahoga County, Ohio. Higher pensions, RMDs from a substantial 403B. Combined baseline magi of $210,000, sitting $2,000 under the IRMAA cliff. Bob pays cash for a $50,000 Lexus, pulls it from the IRA. His 2026 magi jumps to $260,000, leapfrogging Tier 1 and nearly touching Tier 2. In 2028, both Bob and Linda each pay the Tier 1 surcharge. Per household, an extra $175 per month. Roughly $2,100 for that 1 year. Painful, but survivable. Now the version that puts retirees in the hospital. Frank and Rose, retired physicians from San Diego, both 71. Their baseline 2026 magi without any IRA withdrawal, $260,000. Already in Tier 1, already paying surcharges. Sitting $8,000 below the Tier 2 cliff. Frank wants a Tesla at $60,000 and, channeling 40 years of debt-free dogma, refuses financing. He pulls $60,000 from his traditional IRA. Magi jumps from $260,000 to $320,000, sailing past Tier 2 and eyeing Tier 3. In 2028, both Frank and Rose pay Tier 2 surcharges instead of Tier 1, an extra $111 on Part B and $21.60 on Part D, times 2 spouses, times 12 months. $3,176 in incremental IRMAA. Add federal income tax on the $60,000 withdrawal at their 24% marginal rate. $14,400. Add California state tax at 9.3%. $5,580. Add partial phase-out of deductions and net investment income tax exposure. All-in cost of paying cash for that $60,000 Tesla, between $24,000 and $26,000 in taxes and surcharges. That is a 40% confiscation rate on the withdrawal. 40%. To avoid a 7% loan. By the time the bill arrives in 2028, the car is already 2 years old. The Tesla has depreciated 20%. The thrill is gone. And you're paying $1,000 a month in extra Medicare premiums because of a decision you made in March 2026 that nobody bothered to warn you about. So what do? I am not in the business of yelling at retirees. I'm in the business of arming them. 3 doors. Door 1. The lump sum IRA withdrawal. We just dissected it. It costs 20 to 40% of the withdrawal in combined federal tax, state tax, deduction phase-outs, and IRMAA surcharges. It converts tax-deferred income into ordinary income at maximum velocity in a single year. It gives the IRS its biggest possible piece of your retirement in one shot. This door is the trap. Do not walk through it. Nail it shut. Door 2. The bank auto loan. Yes, actual debt, actual monthly payments. The thing your generation was taught to avoid. Hear me out. A $50,000 auto loan at 7% over 60 months. Monthly payment of $990. Total interest of about $9,400. That payment comes out of your existing post-tax income. Social Security, pension, RMDs you have to take anyway. Not a single extra dollar of MAGI is generated. IRMAA doesn't move. Your senior bonus deduction stays intact. Your bracket doesn't creep. You pay $9,400 in interest to the bank and avoid $15,000 to $26,000 in taxes and surcharges. Net win: $5,000 to $17,000, depending on your state and which IRMAA tier you would have crossed. The interest you pay the bank is the cheapest insurance policy you will ever buy against the federal tax code. And in month 18, when rates drop, because the Fed always cycles, you refinance at 5%. Or you do partial Roth conversions in low-income years and use those post-tax dollars to pay down the loan. You spread the tax exposure across multiple years instead of taking one catastrophic shot. Door 3. The portfolio line of credit, or securities-based loan, or pledged asset line. This is what the sophisticated use and almost no retiree knows it exists. You have a non-qualified taxable brokerage account, not the IRA, with, say, $400,000 in mutual funds. The brokerage will lend you up to 50% of that value, typically at SOFR plus 1 to 2%, which in 2026 is around 6 to 7%. You borrow $50,000 against the account. You pay the dealer. You drive off the lot. What happened on your tax return? Nothing. Loans are not taxable events. MAGI doesn't move. IRMAA is unaffected. Your bracket is exactly where it was yesterday. You pay interest only. No required monthly amortization, at roughly 6.5%. Your portfolio keeps compounding at 7 to 9%, while you borrow at 6.5%. You're borrowing at 6.5% against an asset growing at 7.5%, a positive carry of 1% on top of avoiding the catastrophic lump sum tax hit. This is what Warren Buffett does. He never sells. He borrows against the position. The position compounds. He pays interest from dividends. He passes the position to heirs at death, where they receive a step-up in basis under IRC Section 14, and the embedded capital gain disappears entirely. The wealthy treat depreciating assets, cars, boats, vacation rentals, as line items to be financed, not paid in cash, because they understand the cardinal rule of retirement finance: never voluntarily generate ordinary income. There is a fourth door I'll mention briefly: the HELOC. Same principle. Borrow against an existing asset, your home, at a relatively low rate. Loan proceeds are not taxable. MAGI is unaffected. The downside is your house is now collateral for a depreciating asset, which makes me nervous. And HELOC rates in 2026 are higher than 2021. But for a retiree with substantial home equity and no taxable brokerage account, a HELOC still beats the IRA lump sum. Here's the principle at altitude, because I want you to understand the rule, not just the tactic. In retirement, your most valuable tax asset is the management of your MAGI. Every dollar of MAGI you avoid generating is worth 22 to 40 cents of preserved wealth. Every IRMAA tier you avoid crossing is worth $2,000 to $8,000 per year per couple. Your MAGI is a financial garden. You tend it. You do not let a salesman in a polyester tie hand you a flamethrower and tell you to set the garden on fire to save 7% on a depreciating asset. And here is the reason this trap works so perfectly. The system has weaponized your virtues against you. The same discipline that paid off your mortgage. The same pride that kept you out of credit card debt. The same self-respect that says, I pay my own way. The IRS knows you have those virtues. The auto industry knows you have them. They have priced them into the dealership financing offer. They are counting on you to refuse the 7% loan out of pride, and counting on the fact that nobody in your life has ever explained to you that the 7% loan is the tax shelter and the cash withdrawal is the bonfire. The dealer wants the sale. The brokerage gets the withdrawal fee. The IRS gets the tax revenue. Everyone in that chain wins when you write the check. Only you lose, quietly, in increments, over 24 months, in IRMAA letters and bracket creep, and senior bonus phase-outs. You will never connect back to that afternoon in March 2026 when you felt so smart driving off the lot. Before you walk onto any car lot, do 5 things. 1. Calculate your current year MAGI projection using last year's return as a baseline. Know how close you are to the next IRMAA tier. Print the 2026 threshold table and tape it to your refrigerator. 2. Calculate the all-in tax cost of any lump sum IRA withdrawal, federal, state, deduction phase-outs, and the projected IRMAA hit 2 years out. Get the real number, not the wishful number. 3. Get a written rate quote from a credit union. They consistently beat dealership financing. 4. If you have a taxable brokerage account, call the firm and ask about a portfolio line of credit. Get the rate, get the borrowing capacity, compare. 5. Run all 3 numbers side by side. Lump sum cost, bank loan cost, portfolio line cost. In 95% of cases, the lump sum is the most expensive. In 95% of cases, the people you trust have not run this calculation for you. Then walk into the dealership with the spreadsheet, with the pre-approval, with the strategy. Watch Brad pivot to extended warranties and paint protection. Smile politely. Decline everything. Drive off in your new vehicle. Debt attached, but tax protected. MAGI intact. IRMAA undisturbed. Senior bonus deduction fully preserved. One final warning. The IRA lump sum to buy a car is just one example of a broader pattern. Whenever you are about to make any large purchase in retirement, a car, a vacation home, a remodel, a medical procedure, an RV, anything over $20,000, your first instinct will be to write a check from the biggest pile of money you have, which is almost certainly your traditional IRA or 401k. That instinct is the trap every single time. The bigger the check, the bigger the trap. Every dollar you withdraw is ordinary income. Ordinary income drives MAGI. MAGI drives IRMAA. IRMAA drives healthcare premiums for the next 24 months minimum. The rule for the rest of your retirement? Large purchases get financed against existing assets, not funded by liquidating tax-deferred accounts. Always, without exception. The interest on the financing is the cheapest tax shelter you will ever buy. The saved interest of the cash purchase is the most expensive financial myth you will ever believe. Smash like if I just saved you $25,000. Drop a comment. Have you done this? Did your accountant warn you? Are you about to do it next month? I read every single comment. Subscribe with the bell on, because next week we're going inside the Roth conversion ladder, and how the same retirees who fall for the cash at the dealership trap are simultaneously missing the single greatest tax planning opportunity of the next decade. Save this video. Send it to one retiree you care about today. One conversation now saves them $75,000 later. I'm the retirement insurgent. The system is rigged. The math is brutal. The truth is on this channel. Stay liquid, stay angry, stay free.